Imagine turning just $100 into $1,000 in less than a year. Sounds impossible, right? But the truth is, people who understand the power of value investing have done it for decades. In fact, Warren Buffett turned a $10,000 investment into $100 million. It's all about smart, patient investing. Here's a shocking fact. According to a study by Dalbar, 75% of individual investors underperform the market year after year. Why? Because they focus on the wrong strategies. The good news is, you don't need to be a genius to get it right. You just need the right tools. In this video, I'll show you how to go from $0 to $100,000 in 2025. We're going to break down simple strategies that anyone can use, no fancy degree required. I'll teach you how to spot undervalued stocks, reduce risk, and create a plan that will set you up for long-term success. So, if you're ready to take control of your financial future, stay tuned. By the end of this video, you'll know exactly how to turn small steps into big returns. Let's dive in. Chapter 1. Starting with nothing isn't a setback, it's an opportunity. Many successful investors, including Warren Buffett, started with small amounts, but they were wealthy in mindset. In fact, Buffett once said, "The best investment you can make is in yourself." This is the first step, developing a wealth mindset. You've got to see the possibility before you see the money. Think about this. In 1980, Amazon was a tiny startup with no profits. Yet, its founders believed in the vision. Value investing is about having faith in the future, even when it's hard to see it. This mindset is crucial for turning $0 into something big. The journey starts with education. Learn how businesses grow, how to analyze stocks, and how markets work. The more knowledge you gain, the more confident you'll feel making investment decisions. Without knowledge, you're flying blind. By reading just 30 minutes a day on investing, you'll quickly build a strong foundation. But here's a fact that's often overlooked. 90% of investors never bother to learn how to assess a company's true value. Most just follow trends. Don't fall into that trap. Develop your skills, read books like Benjamin Graham's The Intelligent Investor, and trust in solid research. The only get-rich-quick strategy is pure luck, and you can't count on that. When you start, keep your expenses low. You don't need fancy tools or subscriptions to dive into value investing. Some of the best resources are free. Websites like Yahoo Finance and Google Finance give you access to company data and financials, so take advantage of them. Don't expect overnight success. The secret to wealth isn't chasing fast returns, it's staying patient and disciplined. Consistency, not speed, wins the race. Chapter 2. Now that your mindset is set, let's get into the specifics of how to build your investment strategy. First, understand this. Investing is not about following the crowd. It's about creating a path that fits your unique goals. One key principle of value investing is identifying companies that are undervalued compared to their true worth. Think of it like buying a $100 item on sale for $50. Sounds like a great deal, right? That's the essence of value investing. It's not about jumping on hot stocks, it's about buying solid companies at a price lower than their worth. Start with identifying the right screening tools. One simple metric is the price-to-earnings (P/E) ratio. If a company's P/E ratio is lower than its industry average, it might be undervalued. But always dig deeper. Just because a stock is cheap doesn't mean it's a good investment. A well-known strategy is focusing on dividend-paying stocks. These companies are often more stable and tend to have strong fundamentals. Look for businesses with a long history of paying dividends. A 3% dividend yield may seem small, but reinvested over time, it can lead to serious growth. Also, keep an eye on the debt-to-equity ratio. If a company is over-leveraged, it could be a red flag. Look for businesses with low debt and steady cash flow. A company with a strong balance sheet can weather market storms, which is vital for long-term growth. Now, let's talk about the magic of compounding. The earlier you start investing, the more you can benefit from this power. For example, if you invest $5,000 at a 7% annual return, in 10 years, you'll have over $10,000. The earlier you invest, the more time your money has to grow. So, don't wait for the perfect opportunity, start now. Remember, consistency is key. You don't have to invest huge amounts all at once. Start with what you have. Even $50 a month can grow over time. It's the regular investments that accumulate into significant wealth. Chapter 3. If there's one lesson that separates successful investors from the rest, it's patience. Many people think investing is about fast gains, but the reality is different. Look at the long-term growth of companies like Apple and Coca-Cola. They didn't skyrocket in a year, they grew steadily, often through difficult periods. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." This is the value investing approach: buy and hold, for the long term. When you invest in great companies, time becomes your ally. Over time, you can witness the power of dividends and capital appreciation. Imagine investing in a company like Microsoft 20 years ago. If you'd purchased $1,000 worth of shares, it would be worth over $20,000 today. That's the benefit of holding on. Let's add another layer of strategy: the margin of safety. This principle, introduced by Benjamin Graham, advises you to buy stocks when they are priced below their intrinsic value. This safety net protects you from market downturns, ensuring you're not overpaying for your investment. Keep an eye on your investments but resist the urge to check them constantly. Chasing stock prices leads to emotional decision-making. Instead, trust the research you've done and let your investments do the work for you. Successful investing doesn't require constant action, just steady, thoughtful management. Studies show that investors who hold for longer periods significantly outperform those who trade frequently. A 2020 study found that long-term investors in the S&P 500 earned an average annual return of 7.6% over 30 years, compared to 4.5% for those who traded in and out. That difference compounds quickly. Another fascinating fact: the average investor loses money over time. Why? Because they often act on fear during market drops or chase after short-term trends. In value investing, you buy based on real value, not market noise. This strategy lets you sleep at night during market volatility. Lastly, keep your emotions in check. Don't panic during a market dip, and don't celebrate too much during a surge. The goal is to ride out the highs and lows while focusing on the steady growth of your investments. If you're enjoying this, make sure to hit that subscribe button and turn on notifications so you don't miss the next chapters that will take you from beginner to pro in value investing. Chapter 4. In the world of value investing, finding undervalued stocks is like hunting for treasure. But it's not about luck, it's about knowing where to look and how to assess. If you're looking to turn $0 into $100,000, this is where the real magic happens. Start by looking at a company's intrinsic value. This is what the company is truly worth, beyond its market price. There are a number of ways to calculate this, but one of the most popular is the discounted cash flow (DCF) method. The DCF looks at a company's future cash flow and discounts it to today's value. If the intrinsic value is higher than the current price, you found a potential winner. Another method is the price-to-book (P/B) ratio. A P/B ratio under 1 can signal that a stock is undervalued. This is especially true for companies with solid assets but poor market recognition. For instance, banks often have low P/B ratios but can be valuable investments if their assets are strong. Here's an interesting fact: most investors ignore small-cap stocks, which are smaller companies with a market capitalization under $2 billion. But according to data from Morningstar, small-cap stocks have historically outperformed large-cap stocks over the long term. These smaller companies can be undervalued gems waiting to grow. Look for companies with strong fundamentals but weak short-term performance. For example, maybe they're in an industry that's temporarily out of favor. But if they have solid cash flow, low debt, and a strong competitive edge, they could bounce back when the market realizes their potential. Another strategy is to focus on sectors with long-term growth potential. Technology, healthcare, and renewable energy are all industries poised for growth. However, within those sectors, there are companies that are currently undervalued but have the resources to expand. Research is key here. Don't overlook qualitative factors. It's not just about numbers. The company's management, its brand strength, and its market position also play a big role in determining long-term value. Always look for companies that have a clear competitive advantage, known as a moat, which helps them defend their market position. A final tip? Use tools like stock screeners to filter out companies that meet your criteria for undervaluation. Websites like Finviz or Morningstar offer these services for free and can save you hours of research. The goal is to identify a list of potential investments that align with your value investing principles. Chapter 5. Investing is all about risk and reward. But what separates successful investors from others is the ability to master this balance. If you're going to turn $0 into $100,000, you need to understand risk in depth and know how to mitigate it. The first step in risk management is diversification. Spreading your investments across different industries, sectors, and even asset classes helps to reduce your overall risk. If one investment drops in value, others might rise, balancing out your portfolio. According to studies, portfolios with at least 20 different stocks perform better than those with just a handful. And it's not about throwing money randomly at different sectors. It's about choosing companies with strong fundamentals in diverse areas that fit your value investing strategy. Another strategy is focusing on blue-chip stocks. These are large, established companies with a history of strong performance. Stocks like Apple, Microsoft, and Johnson & Johnson are great examples. Though they might not have the explosive growth of smaller companies, they are generally safer bets with steady returns. You can also mitigate risk by understanding your own risk tolerance. Some investors can handle high levels of volatility, while others prefer a steady, less risky path. Assessing your tolerance is crucial before making significant investments. Start small and increase your exposure as you grow more comfortable with market fluctuations. One underrated way to reduce risk is to use the margin of safety, a concept introduced by Benjamin Graham. This means buying stocks at a price significantly lower than their intrinsic value. The bigger the margin, the less risk you take on. This ensures that even if things don't go as planned, you're still protected. While diversification in blue-chip stocks help reduce risk, it's also important to avoid overly risky investments. Penny stocks, for example, are often volatile and speculative, making them a poor choice for a value investor. Stick to companies with proven track records, strong fundamentals, and clear growth potential. Another valuable risk strategy is to keep a portion of your portfolio in cash. This gives you flexibility to act when opportunities arise, without having to sell other investments at a loss. Financial experts suggest having at least 5–10% of your portfolio in cash to weather market downturns. Finally, remember that risk is an inevitable part of investing. No one can avoid it entirely, but managing it smartly through research, diversification, and a disciplined strategy can help you safely navigate the road to $100,000. Chapter 6. Building wealth through value investing is one thing. But how do you accelerate your progress when you're starting from $0? The answer lies in supplementing your income with side hustles. According to a 2020 survey by Bankrate, 45% of Americans have a side hustle. And many of these people are using the extra income to invest. Whether it's freelancing, driving for a rideshare service, or running an online business, the key is to increase your cash flow so you can invest more. A side hustle allows you to funnel extra income directly into your investments. Even a small amount, like $200 per month, can add up over time. If you invested that $200 a month with an average return of 7%, you'd have over $10,000 in just 5 years. Imagine scaling that over time. The beauty of side hustles is flexibility. You can choose an activity that fits your skills and interests. For example, freelance writing, graphic design, or tutoring can all be done remotely and offer a high return on time invested. If you're good at what you do, the income potential is nearly limitless. However, the key is to stay disciplined. It's easy to get distracted by the instant gratification of spending extra income. But funneling that cash into investments will pay off much more in the long run. Make sure you're not just working for money, but instead, making money work for you. Here's an important strategy to remember. Once your side hustle starts generating consistent income, treat that income as your investment fund. Don't use it for everyday expenses. This will help you stay focused on your long-term goal of reaching $100,000. Subscribe to stay updated with more actionable tips on how to build your wealth and grow your investments. By using side hustles wisely, you'll turn your $0 into $100,000 faster than you thought possible.